cash value life insurance and retirement income. This has been a popular topic forever, using a dividend-paying whole life insurance, and we see this promoted a lot with universal life insurance as a retirement income vehicle. How do I pull income from it? Why though? Why on earth would life insurance, right? If you're new to this, why would a life insurance policy be used to generate retirement income for an individual? Well, here's the reason why. There's the question, tax-free. That is the major advantage, right? We always talk about the cash value and how to maximize that, how to build it up over time. If you play your cards right with a cash value life insurance policy, what you could do in the back end is distribute funds on a tax-free basis. In one of the following videos, we're going to go through several examples and really how to set expectations properly. But the key is, just the short answer is, if we design a policy properly and we pull money out, we can get the money out on a completely tax-free basis, tax-free income, which, hey, who doesn't like that? The thing is though, information is critical. And my personal opinion on this is tax-free income is marketed so heavily because it's effective, right? If I say you can get tax-free income, are you interested? Yeah, I'm interested, sign me up. The thing is, there are instances that can occur with a cash value life insurance policy that can result in taxes occurring. If a policy lapses, if it lapses with a loan on it, if I trigger a MEC and other things as well. Point being is, I as a consumer especially want the information. This way I don't make a mistake down the road that's often not my fault as the consumer. The agent I work with has to educate me, or I've got to do research on my own, whatever it might be. Typically it's the agent's responsibility there, but a lot of times agents are new and they just don't know yet. So that's where asking the right questions, hopefully this video gives you some information as well, just to set expectations properly when I am considering supplementing my retirement income with life insurance. So how do I pull the cash value of a life insurance policy? How do I actually distribute it? Well, there are two transactions which I can execute on a life insurance policy to pull my cash value. I can take a withdrawal, which is exactly what it sounds like. It's like taking a withdrawal, pulling money out of a bank account. Once I pull the money out, I'm no longer earning any interest on it. And then I can also take a policy loan. The advantage to policy loans, we always talk about this when we're looking to use a policy to perhaps buy real estate, pay off debt, is when I borrow against a policy, I still earn dividends and interest on those loan dollars as if they were still in the policy. Very attractive in that respect. The thing is, when I'm taking income from a policy, it often makes sense to withdraw up to my cost basis. That's the total amount I've paid in over the life of the policy, and then begin to loan out the rest. That is particularly true when I look at a low interest rate environment, or if I'm focusing on the guarantees. What I will say is a lot of companies do that. When I say companies, corporations. So when we design policies for corporations, in almost every case, that is the strategy that they are distributing income to their employees, their executives, however that plan was set up. They're withdrawing up to the cost basis and then beginning to take out loans after the fact. Now, here's a big thing to do. This is more so tips for people in the industry and also for consumers hearing this, saying, okay, I've got to make sure that expectations are set properly, because in the life insurance industry, we want to avoid the illustration battle. You know, when I was new to the industry, I saw different life insurance illustrations, and before I knew anything, my assumption was, hey, like this is being projected on a life insurance illustration, the cash value growth and the income, so that's what I should get, right? Thing is, that's not the case. I've got illustrated performance, and then I have actual performance. Are they going to be different? Almost always yes. So we want to avoid just looking at the company or product that projects the best numbers, because will that actually come true? That's the thing I want to consider. Insurance industry, a little tidbit of knowledge here, and we've talked about this before, is the illustrated performance is almost always much greater than the actual performance. Meaning when I open a whole life insurance policy, especially a universal life insurance policy, the actual performance is almost always less than what was projected, and I'm specifically talking about the non-guaranteed values. Guaranteed values, they're guaranteed, they're going to be there. Typically you see whole life products produce a little bit stronger performance, stronger results, I should say, than the guaranteed values. But looking at the non-guaranteed values or current dividend rates, whatever it might be, they illustrate one thing and then perform often a lesser figure. So if that's the case, right, if I show you a policy and you're putting in $500,000 over any period of time, and it projects to grow to $2 million, but it only grows to 1.6. Will you be disappointed? Probably, but it is what it is. It's grown. You still have a positive return. Okay, it looks good. I've got more money than I paid in. Not what I was hoping for, but still better than the guarantees, because we'll show you the guarantees. Income. If you paid in $500,000 and I was showing you, hey, you can pull out $50,000 per year, and then it turns out in reality you can only pull out $20,000 per year, now you're a little bit more than disappointed. Now it's a problem, especially if you were banking off of that income, saying, hey, I'm paying money into this product, I need the income to deliver. But it didn't happen. Now what do I do? That's not a pleasant situation for the policyholder, and it's not a pleasant situation for the agent or insurance company either. That happens. Where we see it happen most and have seen it historically happen most is with universal life policies. That's why we're so big with everyone we work with, whole life or universal, looking at the actual proof, track record, not just projections. Here's the big thing. Show options and be honest. Now, this can be difficult for a new agent, not the be honest piece. Most agents you work with have good intentions and are honest. But the next piece, showing numbers, meaning if you are looking to buy a policy from me, you're saying, okay, I want to pay money into a policy, and how do I take income from this? Which option gives me the most income? The thing is, I can take one policy and show you the best numbers. Maybe I only take a universal life policy because those will always project the best numbers in order to win the sale, because typically the numbers that look the best are going to win the sale. But again, going back to this, I don't want to show you the best numbers and then have a major problem because you only the policy only produced 40% of those values. Now everyone's unhappy, and typically the agent didn't even realize what was going on. So, show the best numbers? Yeah, you can definitely show the best numbers. In a best case scenario, or based on the company's current rates, here's what you can expect. However, I wouldn't bank on that. Let's look at a conservative dividend scale, and then also let's look at a worst case scenario environment. Based off the guarantees, what does the cash value grow to, and what can I pull out in terms of income? Based off of the present dividend rate, middle of the road assumption. This way I see different options, and if I bank on this, the guarantees, saying, okay, here's how much I can pull out in income that's guaranteed. Well, now from an expectation standpoint, setting expectations, I'll be happy because it'll likely produce stronger than that. What's interesting is, especially when you look at the larger mutual insurance carriers, they've operated in a non-guaranteed environment for over 150 years. Right, so the actuary we work with, Scott Witt, actually says he doesn't like looking at the guarantees because he's always seen certain carriers produce stronger values than the guarantees. But I get it from a sales standpoint as well. To set expectations properly, looking at the guarantees gives you a worst case scenario up front. If I get more, I'm happy. If I show you best case scenario up front, and then it only produces the guarantees or middle of the road assumption, but I was counting on this, now I'm not happy. So that's just showing the options, being aware of it up front. Awareness is key, right? If you're aware of everything, what can and cannot happen, you're good. Where you're not that happy is if you're counting on this and this happens, right? I wanted 50,000, but I can only pull out 20,000 because the policy did not produce. So next we are going to look at some spreadsheets. We're going to look at how to maximize a policy for growth, but then taking income from a policy, and specifically what we're going to look at here, this would be interesting, is we took the same policy, we're going to see what it looks like based off the guarantees, based off of a conservative dividend, based off of a very aggressive rate. This way we see everything up front and you kind of get a sample of how to set expectations properly. So I hope the overview video here was helpful. Reach out with any questions, and we'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.